Every single dollar you invest is going to go on one of two journeys. One path, well, that leads to real, genuine growth, where your money is actually working for you. The other path, it's pretty much a dead end. Today, we're going to dig into the huge difference between these two paths, the difference between value creation and value destruction. Come on, we've all been there, right? You're staring at a stock chart and it looks less like an investment and more like a wild roller coaster ride. The price just shoots up, then it plummets, and it feels, well, completely random. It really makes you wonder, is there any logic to this madness, or is this whole thing just a big casino? What should we really be focused on? Well, the secret, it all comes down to one really powerful idea. The price you see for a stock on any given day is not the same thing as the real underlying value of that company. They're two totally different things. And believe me, understanding that gap between them is exactly where smart investors get their edge. Think of it like this. The market price, that's the loud, emotional, headline-chasing personality in the room. It reacts to everything: rumors, breaking news, fear, hype, you name it. But intrinsic value, that's the quiet, steady foundation. It doesn't care about sentiment. It's all about the actual health and the performance of the business itself. It is the company's true worth once you strip away all that daily noise. And look, this concept of intrinsic value, it's the key to absolutely everything. It's all about the fundamentals. Is the company making good money consistently? Is that stream of income reliable? Is it growing? Because in the long run, that is the only thing that truly drives an investment's success. So, how does this all work in the real world? Let's start with the good stuff, the positive side of the equation, what we can call the value creation engine. This is the process that actually turns a really well-run company into a wealth-generating investment for you. It's really just a beautiful, logical flow when you think about it. It all starts with a company just doing its job and doing it well. That strong performance, well, that leads to better and more reliable earnings. And that, in turn, increases the company's real intrinsic value. Now sure, the market price might zig and zag from day to day, but over the long haul, it almost always gets pulled up by that rising tide of real value. So, where does the stock market fit in? Well, it's simply the meeting place. It's the bridge that connects us, the investors who are looking for a return, with those great companies that need our capital to fuel that value creation engine and to keep on growing. But of course, for every success story, there's always a cautionary tale. That engine can also run in reverse. So let's flip the coin and look at the other side, the destructive path of, well, value destruction. Value destruction is basically the perfect mirror image of creation. It's what happens when something goes seriously wrong. Maybe a new competitor shows up, or the company makes a bad decision, or the whole market shifts. The company's earnings start to dry up, the business fundamentals get weaker and weaker, the real value falls, and investor capital gets destroyed. And you can see the exact same chain reaction, just heading in the wrong direction. The business weakens, the earnings decline, and so the intrinsic value absolutely plummets. And just like it did on the way up, the stock price eventually has no choice but to follow that real value on the way down. This right here is the anatomy of a losing investment. Okay, so how do we avoid this disaster scenario? We have to understand what causes it in the first place. What are the red flags we should be looking out for? Let's take a moment and dissect the anatomy of a mistake. It really boils down to two main buckets of risk. The first one, that's on us. It's flawed analysis. This is when we just get it wrong. Maybe we were way too optimistic, we misread the data, or we just completely missed a key fact. The second type of risk is on the company, a deteriorating business. This is when the company itself starts to run into serious trouble, like falling profits, new competition showing up, or an entire industry just heading south. This Jenga tower is probably the best way to picture what's happening. A company's value is built on all these fundamental blocks, things like strong earnings, loyal customers, a healthy balance sheet. Value destruction is what happens when those blocks start getting pulled out one by one, and eventually the whole structure just becomes unstable and is at serious risk of collapse. So what's the big takeaway from all of this? If you want to stay on that path of value creation and, more importantly, avoid the path of destruction, it really all comes down to one core principle. You've got to play the long game. At the end of the day, your goal as an investor isn't to guess the daily noise. It's to do two things, and do them well. First, identify great companies that are steadily, reliably creating value. And second, buy them at a price that is less than what they are truly worth. That's it. That's the formula. And I've got to tell you, this requires some serious discipline because real value creation doesn't happen overnight. It's a process, one that unfolds over years, not days. It reminds me of this great line from the source material. The stock market is all about testing your patience. And it's so true. The market eventually rewards the people who are willing to wait for a company's true worth to finally shine through. And that kind of leaves us with one final question to think about. When you look at your own investments, what are you really focused on? Are you reacting to the noise, the chaos of today's price swings? Or are you focused on the quiet, steady growth of tomorrow's intrinsic value? The answer to that question makes all the difference in the world.